So, okay, so we're gonna do the lesson of the day here, and we're gonna start by building our trading strategy. So every day we're gonna do sort of 20 minutes of this, and it's gonna sort of look as follows. All right. So for day one here, we're gonna do just basic price action. In other words, defining a trend or a yes, it's being recorded. Defining a trend or a direction. All right. And we're just going to do the raw basics of price action here. It's going to seem very remedial for the more experienced traders, but we're going to build up to something over the next few days. Okay, so price action and direction. Then we're going to look at, probably tomorrow, we'll look at a bunch of examples of how trend changes and how to identify when something goes from a downtrend to an uptrend to rangy, from an uptrend to a downtrend, etc. Alright, then we're going to move on to support and horizontal support and resistance, just visual areas, in other words, turning points. Okay, so we're going to have our price action, which is, for me, basically interpreting trend and direction. Now this trend and direction can be intraday, on the longer term, etc. So basic support and resistance. Then we're going to take that, and our next one will be fractals. In other words, and this will also be, there'll be some of this today, but working on the fractals. In other words, how to interpret trend within the context of multi-time frames. Alright, then we're going to look at fibs. Alright, and more important to this, how to generate buy and sell zones. So I'll just put zones here. Alright, how to generate zones from this information using support and resistance, using price action, using Fibonacci, which is basically another way of, defining support and resistance. Then we're going to incorporate moving averages and pivots. Okay, and all of this is aimed at being able to generate buy and sell zones. Okay, and I know this is a little bit messy and there's no preparation here. It's just going to be based on charts in front of us and basic knowledge. Okay, there's no PowerPoint action here. Right. So this is going to be our raw technical strategy. Okay. Then once we've got our zones in place, we're then going to look at things like time of day. Alright, big one, Todd. Huge. Massive. Okay, we're going to look at things like Todd. And then we're going to look at things like confirmation. Okay, in other words, when we're in the zones and we got the right time of day, etc., we're going to look at specifically what sort of price action we're going to need around those zones. Alright? Yes, we're going to look at, training days versus sideways days, etc. Okay, once we got this confirmation right, then we're gonna boil this down to the type of trade attempted relative to what you're looking at for that day. In other words, is it going to be a scalp? Is this a trade you want to be in for an hour? Is this going to be a spot trade? Is this something you want to be in for 3 or 4 hours? Is it swing? Is it going to be swing trade orientated? Okay, is this going to be long-term orientated? Alright, so this is going to be sort of how we build this little strategy. Okay, and the type of trade is going to largely depend on our fractals and where we are in relation to, because not every trade is going to be a home run. Not every trade is going to be a scalp. Some trades you want to leave. Alright, some pairs are just trading in a situation where they're not really good on the intraday basis. It doesn't make sense to trade them intraday. Alright, so we're going to look at specific examples of that. Okay, then this is all entry orientated, but after this, then we're going to talk about exit. Okay, in other words, how to define targets. Okay, and this is why I'm perplexed by folks that think they're going to learn trading in 2 months, because you've got to know how to identify these things, but then you've got to have seen hundreds of examples of them. And I'm not just talking about hundreds of examples in hindsight, I'm talking about hundreds of examples in foresight. Alright, you know, when to employ what strategy relative to what market condition. Okay, so once we've worked out targets, then we're going to talk about things like money management, and, you know, in other words, for money management, we're going to talk about risk reward, we're going to talk about adding to winners, cutting losers, we're going to talk about stop losses, we're going to talk about you know, when to manage your trades more actively and when to just leave them alone. We're going to talk about the psychology associated with that. We're going to talk about the trader timeline here. In other words, you know, the development of yourself as a trader. And then when it's all said and done, then the next big one is going to be psychology. Alright? What does it take to develop yourself as a trader? What's it take to get yourself where you need to be? What's it take to get yourself where you need to be psychologically? Alright? And then obviously we're going to tie this all together with, you know, trade planning. Okay, TP. Alright, and I know that's a soup, but this is recorded so you can go back and kind of look at that. Alright, so for today, we're going to talk about price action and just determining price action as a means of direction. You know, we'll talk about a single time frame for now, and then tomorrow we'll start integrating it into multiple time frames. So this is going to be a building process. If you're watching this video and think that this is all I'm looking at, don't. Alright, this is one little building block, and tomorrow's the next little building block, and the day after is the next little building block. So this is going to be a snapshot, very superficial look at things. Okay. So what I'm going to do is I will leave that. Okay, yes, and oscillators. Thank you, Alan. I forgot about the oscillator factor, because we definitely want that in there. Alright, so price action. Okay, one of the biggest things in trading is simply knowing the prevailing direction of a market. Okay, without any indicators here. We're not talking about moving averages, nothing. We're talking purely based on what defines a trend. Now this word trend is used, I think, incorrectly sometimes. So we're going to let's get rid of this little trade. It's a distraction to me, and I don't like us revisiting that level. So this word trend generally implies that something is trending for days, weeks, months, etc. Okay? But trend is, to me, more just an interpretation of the direction of the market relative to when you're looking at it, relative to when you are, you know, the space of time that you're watching it for. Okay, so I've used this analogy before, and I'll use it again. Okay, let's say you have the Amazon River, right? And it's floating downstream. Okay, you know, you might have all sorts of little mountains here, right? And the water might shed off these mountains and flow into the Amazon River, right? And then off these little tributaries you might have other little tributaries that flow into the Amazon too. The Amazon, you know what I mean, right? So you're having these veins of price movement. You have these veins of price movement, okay, that might be completely against the big overall trend. Alright? Okay, so when one looks at trend, you may see trend in this sort of context. In just this small price movement. You might have price heading up, but ultimately in the context of an overall downtrend. Okay? So when one talks about trend, one might be talking about a different direction relative to where the bigger picture is going. Okay? So just today, if I can give you an example, we're getting into market fractals here to a certain extent. But today, if you look at the, if we look at the 30-minute chart here for the euro, for instance, price is making a series of higher lows and higher highs. Okay, so even just on the very short-term direction, price is up. But when one looks at this in the context of this medium term, it's profoundly down. This is a 4-hour. Right, the 4 hours making overall lower highs and lower lows. Hence why we're looking for this. Okay, so when you look at direction, you need to look at it within the context of the time frame you're looking at, but then also realize that that particular direction may just be a vessel or a building block to get you to the next level of rollover or support. Okay, so what is the easiest way to determine this direction? And it's with 6 basic patterns of price action, right? So what we want to know is when price changes direction, it basically does this. It will head up, it will be bullish, neutral, and then bearish. Yes, you're going to have V tops and V bottoms on the shorter term time frames, but typically on a daily/weekly basis, you're going to have a bullish, then a neutral phase, and then a bearish phase. And this neutral phase can take a very long time. Alright, and said differently, on the bullish side, you're going to have bearish, neutral, bullish. Okay? Okay, so the big thing for us here that we need to know is when we are turning from bullish to neutral, and when we've gone from neutral to bearish. And we want to know when we've gone from bearish to neutral, and neutral to bullish, right? We need to know when we are at these turning points of the market, correct? Because then we can capture the upside direction, or we can capture the downside direction. The rangy parts, we want to try and sort of limit our trading. Okay, so how do we determine these bullish to bearish components and these bearish to bullish components? Alright, so a couple of simple little patterns here. Now, there are a lot of different definitions of what a swing is in the market. Alright, and whether you use candlesticks or whether you use bars, I would encourage you not to overthink this, alright? So what constitutes a swing? To me, a swing in the market is simply what I as a swing. Alright, so what are our general patterns for price action changes on a fairly rudimentary basis? Alright, they're as follows. Okay, from bullish to bearish are going to look like this. Okay, swing high, bounce down, lower high, lower low. Okay, so remember, a downtrend consists of a lower highs and lower lows, and an uptrend consists of a series of higher lows and higher highs. Right, so this is chart pattern number 1. Okay, number 2 is going to look like this. We want heads up. You make a double top and a break of this low, and that is your downside direction number 2. Okay, so this one has a little double top and a break of the low. And then one would anticipate sort of something like this as it rolls to the downside. Okay, and then the other chart pattern that you're looking for is one like this. Higher lows and higher highs. And then one breaks these 2 swing lows. So there's no preceding lower high or double top like this, but it breaks these 2 swing lows. Right, then price pulls back and continues to the downside. Okay, so it's the break of these 2 swing lows that would give you that change of direction to the downside. So I'll call this a little chart pattern number 3. Alright. Okay, so then that gives us our bullish to bearish rollover, and now our bearish to bullish is simply the reciprocal, right? So making lower lows, lower highs. Then you make a higher low and a higher high. So here it is. Swing low, swing high, higher low, break of that high, higher high. Okay, so it's the same as this one right here, just the reciprocal. Okay, it's a differently. The double bottom break of the high, okay, is the same as number 2 here. So here's your double bottom and a break of the high. That would constitute a change of direction. Then the other one is the break of the last 2 swings. So that looks like this. Lower high, lower low, lower high, lower low. And then a break of those last 2 swing highs. Price then pulls back and continues. Alright? So those would be your basic changes of direction. Okay, so what would those look like in the market? Alright, if we take a look at, and what we're going to do today is we're just going to identify a few of them, and then tomorrow we're actually going to back test looking for those changes of direction. So for today, I just want to we'll keep this video down to a reasonable level here. I wanted to show you what this looks like in reality. Take off the scroll here. Alright, so let's take this for example. Alright, here's a daily pound chart. Notice how we're making higher lows and higher highs. Okay, now remember the swings to me should not be taken too literally. They should be what is obvious to you. Alright, so I'd take this as a swing, that's a swing, that's a swing, that's a swing. There. So don't get too specific about what the swings are. If they are obvious to you as a swing, then they are a swing. Alright, and like I said, as we go through this, we'll elaborate on it. So in other words, would this be considered a lower low with respect to that? Yes, I would think so. Is it the most obvious swing? Probably not. So therefore, I would probably look at that as not necessarily a lower low, even though price printed a lower low. Okay, it is not profoundly obvious to the eye. Okay, so let's continue further. Okay, now it is. Now to me, that now is a lower low with respect to this and a lower high. So now we have our chart pattern going. Lower high, lower low. Right, we have this one. Therefore, this is a change of trend to the downside on a daily basis. Let's cruise forward a little bit. Okay, and here's our little pullback and rollover, right? So you can see the chart pattern reveal itself. Here it is. Swing high, swing low, lower, if you're looking at this as a lower low with respect to that, then there's your change of trend. If you're looking at this as the lower low, well then you have lower high, lower low with respect to this, and that is your change of trend to the downside. Then price makes a little pullback and continues down. Okay. Here is our little chart pattern from bullish to bearish again. Higher lows, higher highs, higher lows. Alright, goes up, makes what is effectively a double top. Breaks the swing low, that gives you a change of trend to the downside. So here it is. Double top, break of the low, pull back. This is now a bearish signal. Down she comes. Alright, so these little chart patterns can be used on multiple time frames. Alright, so if you're looking at this is a bullish to bearish change on a daily, but now let's look at it on a 15-minute basis for today. Remember, we're not taking this in context yet. Okay, I'm taking this completely out of context just as the raw example of how to interpret a change of trend. Okay, so here is price making lower highs and lower lows. So we went from a daily, now this is a 15-minute. Okay, and now we've made a higher low and a higher high with respect to this previous swing. So this chart pattern is this one, right? It's the bearish to bullish of the number 1 pattern. Okay, and even if you don't interpret that as a higher low, then certainly this is. And then that's the break of it. So if you want to look at it, this is a change of direction here. Okay, then it's a matter of trying to spot your zones by which to long it if it makes sense. Alright, so there's a couple of very basic bullish to bearish changes of direction. Alright, and then tomorrow what we're going to do is we're going to look at more examples how to see these changes of direction, and then we're going to start to look at how they play out within the context of the medium term and longer term trends. But that is our price action lesson for the day.